Good afternoon, everyone, and welcome to today's webinar. I'm Yoshi Itoku. I am the Communications Facilitator for Printing Industries, and with me today is Wade Oldham, the Principal of Wade Oldham Finance. Mr. Oldham has 30 years' experience in the finance industry and has provided financial services to everyone from small business owners right up to the Reserve Bank of Australia. In today's webinar, Mr. Oldham will be discussing equipment finance, working capital finance, property finance, and business acquisition and mergers finance. If at any time you have any questions, please feel free to type them into the questions box, which is between polls and chat, and I'll be happy to read them out for you at the end of the webinar. So that's it from me. I'll now hand you over to Wade Oldham, and he can begin his presentation.
Good afternoon, everybody, and thanks for joining us today as I try and uncover a little bit of information about financing with the printing industry for you. We've provided financial advice to support the business of many sizes and backgrounds over many industries, including the printing industry. Some of those industries are involved through manufacturing, civil, hospitality, media, mining and waste, and as Yoshi said, even the Reserve Bank of Australia once upon a time. Our businesses, our clients' businesses range, most recently this week, a small client in a regional Victorian town with a turnover of $360,000 up to larger companies with multi-million-dollar turnovers, so fairly widespread experience. In the 30 years that I've been involved with the printing industry, I've seen windfall times of the industry from 83 through to 89, the subsequent recession of 89-93 when many businesses were lost, and the boom years of 95-01 and again 2002 through to 2008. With financial advice, we look to identify the funding options best for your business. We recommend funding sources and arrange it for you. A recent example, we know the credit people. We know what they like and what they don't like in different banks. We don't follow banks, we follow the people. When they move, we follow with them. There are some people that are averse to the printing industry. We stick clear of them for printing industry clients. There are other banks that are fairly happy with the printing industry, and so we naturally follow those. With your debt structuring, we try to ensure that the stakeholders with a skin in the game are as protected as possible. That is to ensure that they're not offering up more security than they need. We try and keep your personal assets separate from the business lending. Give you again another example. Just recently, with a company with an $18 million turnover, and it was actually a profitable company. It made $1 million net profit. It had bought an asset and paid 50% cash deposit. Now, we were able to finance that without directors' guarantees. That's the sort of thing by I mean looking to benefit you, the client, rather than what the bank actually wants. Now, the bank, not every bank would actually approve that, by the way, either. But we had a select ability to do it, so we did it. Just excuse me while I try and find a note here.
Technology, eh?
It's great, isn't it? We're looking to provide expertise on the most appropriate business structures, and we also act as a third-party perspective on your business operations to be able to provide you with suggestions and risk mitigant strategies that will help your business. When I talk about that, I'm meaning that we will, with a number of businesses that I finance through the printing industry, I keep my own stats on things such as what their wages to sales and percentage is, what equipment finance costs percentage to sales, what rent cost percentage to sales. I can then pinpoint where your business is by looking at your financial statements and tell you whether your sales, so your salaries are too high for the industry, or if you've got too much financed to be healthy within the industry, or indeed not enough financed to be healthy within the industry. There's some of the things that that you're not going to be able to get from somebody that's not industry specific. The primary function of a business and finance consultant like myself is to diversify your business's debt. With that in mind, and I'll explain a little bit to you, there are two significant debt platforms in any business. The first is your core debt, and your core debt can be your bank overdraft. It can be a loan where you borrowed goodwill to buy another business. We also look to an overdraft, and we'll work out whether it actually fluctuates. A lot of people might have an overdraft of 200,000 and it fluctuates between 180,000 and 210,000 over its limit. That's not actually an overdraft, that's core debt, and that needs to be looked at and redesigned to be more efficient for your business. More efficient in that an overdraft rate is probably more like 10.5%, a business loan rate 7.5 to 8%. So you can see there are ways of doing it that the bank's not necessarily going to let you know. If he's going to increase his margin 3%, he's probably not going to jump all over you to let you know about it. Other debt includes peripheral debt, which is the majority of equipment finance for ITs, vehicles, plant machinery, printing presses, bindery, etc. Peripheral debt is the one where we spread around a number of different financiers away from your core debt holder. That is to say, if your overdraft or business finance facility was a Commonwealth Bank, that's one place we wouldn't go. That then gives you some diversity of repayment record with several other funders. The strategy of spreading your debt between multiple lenders ensures minimum encumbrance of your assets and discourages complacency amongst our lenders to make sure that they're all actually bidding for your business. Overdraft debt is fixed, it's inflexible, and it's usually secured by real estate. An alternative to an overdraft would be invoice discounting or debtor finance. This is a flexible product. It's secured by debtors and not expensive if used wisely. When I say that, debtor finance can typically have a realisable interest rate in the order of 12–13%. However, if you use it wisely, you may go to your creditors and ask for an early discount payment from your creditors. If you're currently paying them 30 days, you have the option of going to them saying, I'll pay you 25 days, I want a 2% discount. When you offset that 2% of your purchases against the cost of invoice discounting, you're actually bringing the cost of the invoice discounting way down below the 10 or 12% and making it a very efficient product. That takes a fair bit of discipline, but as a business owner, you already have that discipline. In the peripheral debt, keeping a spread of lenders ensures that one lender that may have adversity to an industry at any one time, you have a repayment record with others that we can turn to. Some lenders have it on record not to lend to a certain industry, and I don't just mean specifically the printing industry, whilst there are some lenders at the present time that certainly do have that. There are some lenders that have adversity to construction industry, to cranes, to transport, or have fairly heavy restrictions on those industries as well. So the printing industry is not singled out really. It's just part of the way banks treat people. Our process for securing finance for you, we need to get to know you. We need to understand your business. You need to trust us. We need to trust you. We need to know how your business operation works. In general, there are no application or consultant fees unless pre-agreed, and no obligation to proceed from the initial discussion. In the majority of cases, the equipment finance is secured against the equipment alone, without encumbering any personal assets. Now, when I say that, it's important that you have personal assets, because a lender that sees you without personal assets is going to say, well, hang on, if times get tough, how's this bloke going to raise money to support his business? So that's a reason why a bank might ask for an asset liability statement or a copy of a rates notice to prove that you own a property. We liaise with the supplier of your choice, order the invoice, prepare all the paperwork for your signature, and then bring it out to you. We then go on to pay the supplier. You take equipment of delivery. You take delivery of the equipment. We also arrange for some businesses, depending on your needs, an annually renewable pre-approved equipment finance facility for future finance acquisitions. Most small business finance products include leasing, though it's not greatly used these days. Commercial hire purchase is also fallen off the radar a little bit since changes to GST in June 2012. We use commercial hire purchase mostly for asset loans over $500,000. Chattel mortgage finance is the predominant financing product for equipment these days. Accountants seem to prefer it. The industry's adopted it. We also have debtor financing or invoice discounting, as I mentioned before. It's a product that, if used sensibly, is very cost effective and helps you grow your business. Insurance premium funding is another one that not too many people think too much about. You get your annual insurance renewal. The broker says, here, renew it. Do you want to take the terms of 10 months? You sign it and say, yes, please, thank you. What we've found recently is that it's a pretty uncompetitive product that the finance brokers are offering, which largely is an extension of the insurer that they have set you with. I found out that there's a few hands in the pie there, and so the pricing is fairly high. We have arranged significant premiums, two large ones in the last couple of months. One was $104,000, the other was $149,000. So when you get in those sorts of dollars, it does add up. The other thing that we've been able to do is actually produce a 12-month payment program for these insurance premiums. Most insurance company renewals will only allow you 10 months, so we're giving you a little bit of a bonus for the extra 2 months there. Now, back to your business. Basically, once we get to grips with what makes you tick and the increased opportunities that your next financial requirement can bring, we can present your equipment finance application in the best possible light to the financiers. Best possible light to financiers, as I said before, things like ensuring that if you've got tax debt, we've covered that off up front rather than finding it later and all things go to spoil. Looking at your business inside out. So what we ask for is absolute openness, and let us build a finance application that's going to show your business in the best possible light. Okay, we're on the screen now with our finance model. We hold some pretty sound relationships with most equipment suppliers. Now, when I sort of come to that, everyone can have a relationship, but where it gets critical, if you have an urgent need, and I've got arrangements with financial controllers at the majority of vendors that I can call them and let them know succinctly that you're a credit that's going to be approved, and we can move on with that timely without the critical decision of, does the supplier get that machine from Melbourne, send it to Sydney, rather than waiting 2 days to get your approval. I know it's going to be approved, so I can get him to send the machine from Melbourne to Sydney, vice versa, or anywhere for that matter, and just enhance the time frame of you actually acquiring that. I've said before, we don't encroach on your bank's working capital facilities. It's probably best that you know, if you have a good relationship with your bank, those of you who've still got one, maintain that. We're happy to introduce you to new banks, but at the same time fully respect your existing facilities. My company is one of about 150 throughout Australia. We're members of a crowd called Consolidated Finance Group. CFG is an aggregator within the finance. Now, me as I'll term myself a small business operator, I'm not going to command myself the sort of interest rates that a bigger business would be able to, or a finance brokerage of a dozen operators. What I can do, though, is through my membership of Consolidated Finance Group, which is an aggregator writing over $1 billion per annum in equipment finance, I access CFG's rates and supply them to you. So in a lot of respect, what I get is going to be better than any finance brokerage that might employ 6 or 10 or 12 or 18 finance brokers through its own volume, which probably is only going to be about $250 million a year. We currently serve customers in all states and territories. I think Northern Territory is the only one I don't have a customer in at the present time. As I think I've said before, we ensure that you finance equipment on its own security and without any freehold encumbrances. I've touched on a few of these things before. We know what the lenders look for. So when I'm looking at your balance sheet or going through your P&L or going through your commitment schedule or your asset liability statement, the sorts of information that we need, I can look into that and we can patch up any holes before it gets to application stage. We work out your servicing capacity. I can show you how this works with financiers, so that you understand what they're looking for. There are times where I've had, I've been in a position where a financier has actually approved more than what a borrower is prepared to borrow. It's not often, but it does happen. We diversify your lenders to keep your exposure to any one lender at a minimum. Typically, if you wanted to borrow money to buy 6 machines at an average of $100,000 each, you've got an aggregate of $600,000, we would probably use 3 different lenders and keep the aggregate at $200,000. That ensures they ask the least number of questions, they approve your finance quickly, and there is no price differentiation between $200,000 and $600,000, so it comes back to the keep it simple model. We're an independent company. I don't have any white label products that I push. I don't have any financiers that I push. My clients are the people that I push, and that was pretty much evidenced when the employer a long time ago said to me, "No, we don't like these clients." I said, "Well, I do. Goodbye," and I went to work for myself so that I could work for you. Okay, where are we up to?
We're just moving on to, I believe, banks versus financial companies, and why would you pick one over the other?
Here we go. Okay. And are we up to slide 11, Yoshi? Where am I?
Whatever you like. It's your show, but I do feel you have touched on these topics a little bit.
Okay. All right. Now you probably need a motivation to switch from a bank to a finance consultant. Look, only your motivation can make you do that. You've got to want to do it. We find usually because the existing finance is too heavily reliant on the director's assets, or they were dissatisfied with other parts of the debt structure. A finance consultant can compare loan requirements across its panel of providers and negotiate a better deal on your behalf. We also deal with a number of banks directly, and I said before, we deal with the people at those banks, so I don't really mind if it's an ANZ or a Westpac or a CBA, whoever the person that's doing a good job, that's where we'll introduce a customer to. If you are dealing with a bank directly, they are usually looking to take as much security as they can, including your personal assets as security. While sometimes this is appropriate, mostly banks just can't help themselves from taking excess security. If you've offered your bank a general security charge, or GSA, this is what was formerly known as a fixed and floating charge. These are pretty savage assets for a bank to hold. Basically, a GSA, if you've got an overdraft and it's secured by real estate, it should not be secured by a GSA as well. A GSA is a powerful tool. It actually gives a bank the ability to appoint administrator at will, and that means that you're sort of losing control of your business. I've also been asked to come into several clients to try and unravel their business debt. That business debt, it may have been required to unravel because of a divorce, because of a partnership split, the utilisation of personal assets in the business to secure the lending. That takes a little bit of time. It's not the sort of thing that you want to try and do yourself. If for no other reason than you're allowed to get yourself into that position in the first place, it's probably best to get somebody with some experience to start and unravel it for you. And there's plenty of ways of doing it. It's not easy, but it certainly can be done. A finance consultant, his job is to mitigate risk, improve your security and pricing that you're able to get from a bank for all of your debt requirements, be they core debt or your peripheral debt. Some areas that you may not be aware of that the bank's going to have you caught up with might be restrictive covenants and conditions which are relative to your balance sheet. These can often be costly and time-consuming, especially when it comes to annual reviews or audits. A lot of what a good finance consultant will do for you is to negotiate covenants and conditions out of a loan agreement. By limiting the restrictive covenants and by limiting conditions, what we're actually doing in the long term is saving the business time and money. Businesses, if I go on to another area of what I see a lot of businesses use because they think is nice and easy, that's vendor finance. Vendor finance has crept into the industry in large waves of recent time. You've got your Konica Finance, Canon Finance, HP Finance, Heidelberg Finance, on the list goes. You've got, as I see it, two risk scenarios here. Firstly, you're opening up your financial position to the supplier by declaring your full financial position, financial statements, personal assets and liabilities and commitments. I'm not convinced that that's the wisest move for any business owner. And secondly, you've got the possibility that once that supplier has its grips on you, it's very difficult to reverse the position and change the supplier should the need arise. Now, things here like I've seen, I won't be specific with vendor finance names, but vendor finances would have financed a machine. It goes in for 2 years. It doesn't work to your satisfaction. they say, okay, that's fine, we'll pull that one out and we'll give you this new shiny silver one. And we'll just roll the old debt onto this new one. Now, that is called snowballing debt, and that is just ridiculous. That will send any business to the wall very, very quickly. That's a very strong reason to try and avoid vendor finance. I know they make it easy. I know they just say, have you got a heartbeat and been in business since this morning? Yes, we'll approve it. I know that's all easy. However, the long term is where my business sticks around in supporting your business. We want to be here in 10, 15, 20 years' time, probably the same as you would like to be. And anything that we provide finance for today has to continue to work for you in 5 years' time. It cannot cripple you in 5 years' time. If it does, I've failed. Don't like failure. In summary, while industry surveys consistently show that obtaining printing finance is difficult and therefore possibly an impediment to your business development, the reality is that it doesn't have to be, and the reality is that my business is still doing printing machinery finance, and that's the majority of my business. There's certainly been some printing businesses that have crashed, but that happens in all industries, not just the printing industry. And that's what financiers are. You know, they've got a bigger picture. They're seeing the crashes and indeed the frauds, dare I say, in other industries as well. So it's you know, if you take a bigger picture view of what banks and financiers are looking at, the printing industry is just one, and it's not that negative. We need to present your application well, and you can be pretty well assured of success for achieving the finance requirements that your business needs. One of the things we do as a final note, generally if we look at a finance application and we're a little bit concerned it might be a borderline job, we'll actually table it to a number of different financiers rather than formally submit it. This gives us the ability to negotiate with a number of different credit managers at any time specifically about your business. It does two things. It will weed out who wants to do the deal, or adversely, if those 4 credit managers all say, Wade, this deal ain't going to work, then I can come back to you and say it's probably a pretty good indication that you shouldn't be buying or spending that much money in the first place. Ladies and gentlemen, thank you for listening. I'll hand you back now to Yoshi.
Okay, thank you very much. So as usual, if you have any questions for Wade, please feel free to type them into the questions box. While I just wait for a few more questions to come through, I'll just do some general announcements for some upcoming printing industry events. So firstly, on Tuesday 17th of June and Wednesday 18th of June in New South Wales and South Australia respectively, we are hosting discussions about mental illness and their impacts. So if you would be interested in partaking in these discussions, please check out our industry calendar online for more information. These events are supported by Media Super and Beyond Blue, and the speaker will be the former South Australian Liberal Senator Mary Jo Fisher, and of course she is now a Beyond Blue ambassador and a printing industry's workplace relations advisor. So once again, if you would like more information about that, please check out our industry calendar. And while you're there, take a look at Wednesday the 25th of June, because we're hosting a webinar about creating web pages in Photoshop. So there's no need to worry about any coding. If you'd like to create any kind of web pages for any size screen, any operating system, just using Photoshop, check out our webinar about that, Wednesday 25th of June. Once again, that is in our industry diary. But getting back to the topic at hand, we now have a few questions for today's presenter. So firstly, we often hear that getting printing industry finance is difficult and an impediment to business growth. Listening to you seems that that's not really the case. Is it a matter of how we approach our banks, or should we be looking beyond the organizations we already have relationships with?
Yeah, look, I think if your only approach has been to your bank and your bank says no, then probably haven't gone far and wide enough. Look, I'll go back to just saying a finance consultant is a person that's experienced in producing finance applications. Not only that, but presenting them to the most appropriate lender for the type of asset being purchased. There are lenders that think that printing equipment is really poor quality. There are others that think it's pretty good quality. There are lenders that will finance partitions and fit-outs within your business, and there are others that won't. I mean, and whoever your bank is, they're not going to be able to do it all, or they're not going to have an appetite for it all. One of the things that we largely do is to ensure that your diversity of what the assets are that you want to borrow money for, are actually able to be funded, and that's why we use half a dozen different lenders, because they all have their different nuances.
Righto, thank you. And I now have two questions that are similar, so I might just bundle them together. Firstly, what do you base your fees on? In other words, what's it going to cost me? And do you do all the required paperwork and negotiations for a good rate? And just bundling that with the second question, which was, how affordable are your services for small businesses?
Well, let's go backwards. How affordable are my services for small businesses? Well, it's a bit of opportunity cost, isn't it? If you don't spend the money, you're not going to get the thing that's going to make you the money. Look, I don't have any upfront fees other than those in extraordinary circumstances that are negotiated. Now, that might be through some direct business consultancy that is done on an hourly basis. I have charged clients for that in the past. I have sold printing businesses for clients in the past, where I've been able to put a vendor or match a vendor business to one of my other clients who is in the market to buy a business. I've charged a percentage of the transaction fee as a result of that. That percentage has been significant less than some business brokers will charge. Yoshi, sorry, I'll go back the first part of the question.
What was it? Sorry, I did get a bit tongue-tied. It was similar. It was basically, what do you base your fees on? In other words, what's it going to cost me?
Okay, that'll do. There's no cost with equipment finance or business finance for that respect. The lenders pay us directly. The best way of thinking that is, they, instead of them employing sales reps running around the countryside and costing them, they cost me into their overheads instead and pay me a fee up front for having completed the transaction. If we're unable to complete the transaction for you, in most occasions I would have no charge. If I can't secure the finance, I don't charge. The only caveat I'll put on that is, if I come to you and I say to you, look, I think it's going to be really difficult, I'm not sure if I can do it, there's going to be some time involved here, can you pay me something for my time? That's happened once in 5 years that I can think of. Another area in terms of, is finance always available? I had a client recently who I've done business with over the years. His business model and structure has changed. He wanted to buy a machine, and given the change over the last couple of years, and so his financial position is not presented as well, I tabled it with a couple of my lenders, and the decision was made that, given that this year is a full financial year and he's trading better, it would be better to approach them for finance after the 2014 financial statements have been prepared by his client, by his accountant. And that so is the process. So while a guy asked for the machine in March, we can't do it. We'll go back and revisit it in August, and should be right to go with it then.
Okay, thank you. And just a couple more questions. Firstly, Do you suggest company restructuring if you think it is appropriate?
Yes, I do. There are certain structures that are reasonable. Some revolve around CGT. Some revolve around changing shareholders. There are some ATO rulings where shareholdings change by significant amounts, and that has adverse tax effects to a business. I had just recently, as an example, a business has been trading for about 18 years, and a bit of family upheaval, and ultimately, once we sat down with their accountant and worked out what they wanted to achieve, the easiest way was actually to set up a new business structure where we had a family trust as a trading entity, a company which was the asset-owning entity, and also the main beneficiary of the trust. That was set up as the best go-forward proposition, not for the future, but also mitigated all risks associated with capital gains tax on the company that had changed, or the owners wanted to change so much. So that old company will just stop trading and eventually be wound up. In that circumstance, the lenders fully understood the situation and supported the new entity.
Okay, thank you. And it looks like we have one more question, so if anyone else has anything to ask, now's your chance. But the last question is, if I was unsuccessful with the loan application in the recent past, would that prejudice a future application if I was to engage someone like yourself?
No, not at all. Look, if you've given it to a finance company who's shopped it around willy-nilly, or you've given it to a finance consultant who's predominantly a home loan broker and has no idea about business lending, it may do impact depending on what they've done with it. But it shouldn't have, especially if there's if there's been a financial year change, or as I hinted on a moment ago with a client whose business had changed, and I said to him, look, you're not going to get the finance now, so let's not apply for it. Let's just wait till the 2014 financials are done and go then. Sometimes I have that conversation directly with financiers as well, where we're just out in the open. There's still a lot of financiers that are keen to do business, and they find ways of doing things. They're not all negative. My job is to source those financiers, those people, and utilise them for my clients' best business.
Okie dokie, thank you. And it seems as if there are no more questions, so that's it today. Thank you everyone for participating. Thank you to our speaker, Wade Oldham, and I will see you all next time for our next webinar.